So we came out the gate a little sluggish. Let's call it, I don't know, post-Valentine's Day hangover. But if history is a guide, then the S&P 500 should be up huge. This is why, because we were 5.4% year-to-date at yesterday's close. That bodes well because the track record, check out the Valentine's Day indicator. We give you a bunch of them. The track record for this, though, first and foremost, it works 92% of the time. What does it mean? If the market is up, if the S&P is up more than 4% by Valentine's Day, we go on the rest of the year to average another 13%. Look how many times this thing has worked. From 1951 to 2021, it's only failed twice. Mind-boggling stuff. So maybe we've got some sweet days ahead. Pun intended. All right, investors, listen, they were already loving this market because gobs and gobs of money already coming through. So this is the usual monthly flows of the market. In January, you typically get a lot of money coming into the market. That's your average, 5-year average, 20-year average. This is this year. Look at that spike. That's mind-boggling stuff. So people have been pouring a ton of money into this market already. And it's not just the fresh money that's coming in. You know, a few years ago, all the guests were complaining about margins, you know, how high the margins were. We were at almost $1 trillion in margin. What it means is that people can borrow and actually buy more stocks. Now the margin level is much lower, possibly another $300 billion in potential buying if this thing gets really, really frenzied. But of course, these days, the best way to look at the stock market is to look at the pace of inflation. If inflation is moving lower, stock market's usually moving higher. Now, on that score, we've got something of a mixed picture. Obviously, we are starting to descend a little bit, but some things are happening. Wages are moving a little bit higher. Also, the pace is stalled. And there is an eerie feeling that maybe we can get a directional change. Now, my first guest on this show has been calling for a no landing scenario, in part because of this stubborn inflation that will not immaculately disappear. I want to bring in now Bianco Research President Jim Bianco. Jim, you know, let's start with something you posted yesterday. And this is what we must talk about, I guess. It's Powell's favorite inflation gauge, the Supercore. It's still well above levels that are acceptable to the Fed and Jay Powell. Walk us through this chart and the challenges that we face here.
So the Supercore basically just takes out a bunch of indicators like food and housing and food and energy and some others, so that what we're looking at is a little more than half the index that's supposed to be sensitive to wages. And what the Supercore is doing is it's starting to rise again. It was at it's up about almost 1% since last September, which is worrisome because it means that there might be an increase in wages coming. Now, wages going up is not worrisome, but what that means is that if people are getting paid more money, they can pay higher prices, which would portend more inflation because labor is such a big driver of it. And this has got people worried that the inflation story might not be completely behind us.
And just so the audience understands, the components, medical care services, water, sewage, trash, these are things that, by the way, our audience deals with every single day that maybe sometime Wall Street forgets that. Education, communication, recreational services, transportation services, which are absolutely through the roof. Here is the turn that Jim was talking about, 3.7 to 4.3 in just that short period of time. So, Jim, here's the thing. You've got this. Wages potentially moving higher. Stock market at all-time highs. Home prices are holding in there pretty good. Isn't that the wealth effect that Powell was supposed to extinguish?
Yeah, it certainly looks like that's exactly what's happening. That as the market moves up, people are feeling a little bit more comfortable. And what's different about the post-pandemic cycle is we spend a little bit more. Maybe in 2015 when the market moved up, we were just happy to have more savings. Today when the market moves up, we're happy that we've got a little bit more money to spend. And that's why it's starting to show up in wages or the Supercore and potentially in more inflation.
Now, commodities in general have been drifting a little bit lower here, but gasoline prices, we've got a chart here, and this is the chart you created. I showed a different one yesterday, but gasoline prices are turning higher. I know there's always some interesting things going on within that complex. You know, a refinery goes down here or there. But again, if we start to get gasoline prices on top of what you described, what does that mean? What are the implications for the overall inflation picture?
Well, yeah, I mean, gasoline prices there's a lot of cross currents, and one of them might be that we're switching over or getting ready to switch the refineries over to the summer blends. And that means the winter blends are a little bit short in supply, which is pushing up the price. But nevertheless, the price is going up. This is a big component of inflation, a big component of the driver of monetary policy. And if gasoline prices are going up, even if it's temporary, it suggests that inflation is going to stay a problem. And for those that are looking for rate cuts to help support the market, might get further disappointed.
Yeah. We'll see, Jim. Always appreciate you, man. Thank you so much.
Thank you.
And like Jim, my next guest says, maybe the easy part of